Welcome to the Deep Dive. Today, we're plunging into one of the most intriguing questions in the AI infrastructure space. Is Applied Digital Corporation, ticker APLD on the NASDAQ, truly building the indispensable picks and shovels for the AI gold rush, setting itself up for predictable, long-term profits?
Or is it taking a really high-stakes, debt-fueled gamble on a single massive project that could leave investors empty-handed?
Exactly. By the end of this deep dive, you'll have a much clearer picture of where this rapidly transforming company stands and, what could tip the scales either way.
Our mission today is to distill the most critical insights from a comprehensive stock research report on APLD. We'll help you understand their core business, financial health, market position, and the significant future risks and opportunities.
And just to ground everyone, all our analysis is anchored to the date of June 24, 2025, when the share price was $10.36.
Right, 1036.
All right, with that mission in mind, let's dive straight into understanding what Applied Digital actually does at its core.
Business analysis.
Okay, so at its heart, Applied Digital designs, builds, and operates next-generation digital infrastructure. Think of them as creating these highly specialized, power-intensive data centers that are absolutely critical for the modern digital world.
Specialized for AI, right? That's the big shift.
That's the key. What's most fascinating here is their incredibly rapid strategic pivot. They started out providing data center space for the volatile cryptocurrency mining industry.
Right, I remember that phase.
But they've since shifted hard to capitalize on the explosive growth in high-performance computing, or HPC, and artificial intelligence, AI.
That's a huge and clearly strategic shift. How do they actually make money from this new direction? Let's break down their different revenue streams.
Sure. They operate across three distinct segments now. First, there's their data center hosting business.
Yeah.
This is their legacy segment, providing fully energized space for crypto mining clients.
Okay, the old stuff.
Pretty much. While their facilities in Jamestown and Ellendale, North Dakota are operating at full capacity, generating about $35.2 million in their fiscal third quarter of 2025. The key insight here is how relatively small that is compared to the massive AI infrastructure game they're now playing.
Right, it really signals they're leaving that past behind.
Totally. They're chasing a much bigger prize. Second, they have their cloud services business, operating under the brand Sci Computing. This segment offers GPU as a service, or GPU-AS.
So renting out compute power.
Exactly. Renting out raw computing power from high-end NVIDIA GPUs for AI and machine learning applications. That brought in about $17.8 million in Q3 FY25. But crucially, this segment is under strategic review for a potential sale or restructuring.
Hold on, it sounds like GPU as a service would be booming right now. Why would they consider selling that part of the business? That seems kind of counterintuitive given the whole AI gold rush.
Yeah, it raises an important question, and management has been quite open about their rationale. They argue that operating a cloud service by directly selling compute power creates what they call competitive friction with their target hosting customers.
Ah, the big hyperscalers like Amazon, Google, Microsoft.
Precisely. Those companies also sell compute power themselves. So this proposed divestiture would mean sacrificing a smaller, albeit growing business to secure much larger, more stable, and incredibly long-term leasing contracts with those very hyperscalers.
Okay, I see. It simplifies things too.
It significantly simplifies their overall business, which is a necessary step if they want to pursue a long-term ambition of converting into a data center real estate investment trust, or REIT. That structure really favors a clean landlord-tenant model.
Got it. So what's the third segment? The main event, I assume.
Yes, this brings us to their third and most important segment, the HPC hosting business. This is the absolute core of their future. It involves designing and constructing these massive purpose-built data centers leased long-term to those hyperscalers and large-scale AI companies.
And this is where the big CoreWeave deal fits in.
Exactly. The transformational $7 billion 15-year lease agreement with AI hyperscaler CoreWeave is the foundational piece of this entire growth strategy. It's everything for them right now.
Okay, so they're all about these AI factories. What makes their facilities unique? What are their key offerings that attract someone like CoreWeave?
Their primary product really is these AI factories. Highly specialized infrastructure built specifically for demanding AI workloads. They offer high-density compute hosting, providing scalable capacity for the immense power consumption and heat that these AI chips generate.
Which is way more than traditional data centers, right?
Wow, orders of magnitude more. Crucially, they use advanced cooling solutions, going beyond traditional air cooling with liquid cooling, and strategically locating facilities in cold climates like North Dakota.
Freezing cold North Dakota helps with cooling, makes sense.
It makes a huge difference. This allows for incredibly efficient operations with a projected power usage effectiveness, or PUE, of just 1.18. That means almost all the power goes straight to computing, not wasted on cooling.
That's impressive.
It is. And they also boast near-zero water usage effectiveness, or WUE, at their new sites, which is increasingly important from an environmental perspective. Their designs are also flexible and scalable, accommodating both air-cooled and liquid-cooled hardware. Polaris Forge is kind of their flagship brand for this model.
Okay, super efficient, flexible designs. Given they're still emerging, where do they stand in the market right now? What's their scale compared to the big guys?
Applied Digital is definitely an emerging player, still relatively small. With a market cap around $2.32 billion and trailing 12-month revenue of about $221 million, they're, dwarfed by established data center REITs like Equinix or Digital Realty.
Right, those are giants.
Absolute giants. However, their market position was dramatically elevated by that CoreWeave deal, that 15-year, 250-megawatt, $7 billion lease. That single contract provides powerful validation.
It proves they can play in the big leagues.
It really does. And it significantly de-risks their future revenue, signaling they can compete for these huge projects. They currently have over 400 megawatts of capacity under development, which highlights their ambition to become a much larger player very quickly.
So if I'm a massive AI company, what's Applied Digital's core value proposition to me? Why choose them over building my own data center or going with, say, Equinix?
Good question. Their core value is delivering cost-effective, rapidly deployable, highly scalable data center infrastructure specifically designed for AI.
Okay, cost, speed, scale, AI focused.
Exactly. They differentiate themselves through strategic site selection, finding locations with abundant, low-cost, often stranded power like rural North Dakota, and those cold climates for free cooling.
Stranded power, meaning power that's hard for others to access.
Yeah, often near generation sources, but without enough transmission capacity for general use. It can be cheaper. They claim this site selection strategy can slash annual electricity costs by $50–60 million for a 100-megawatt campus compared to traditional locations.
That's a huge potential cost saving.
It's significant. Plus, their AI factories are purpose-built and inherently more efficient for AI than trying to retrofit older facilities. And they emphasize their speed to market, which is absolutely critical for scaling AI companies that need to deploy compute power fast.
Right. Time is definitely money in the AI race.
No.
To truly understand APLD's potential, we need to zoom out. What are the big picture market trends and growth potentials in this AI data center industry right now?
Okay, big picture. The AI data center industry is experiencing a historic boom. It's projected to grow at a compound annual growth rate of something like 28% through 2030. It's just massive.
What's driving that insane growth?
It's fueled by several powerful trends. First, massive power demand. AI workloads require 5 to 10 times more power than traditional computing, leading to server rack densities soaring over 100 kilowatts per rack. It's unprecedented.
Wow.
Then there's unprecedented capital investment. Tech giants are pouring money in. Microsoft is planning $80 billion by 2025, Amazon over $86 billion. The scale is hard to comprehend.
Just staggering numbers.
And finally, liquid cooling is rapidly becoming the new standard because these AI chips just generate so much heat. Air cooling often can't keep up efficiently.
So Applied Digital seems positioned for those trends. But with all that money flowing in, who are their main competitors in this rapidly evolving landscape?
It's a fiercely competitive environment, no doubt. They face threats from the established data center, REITs Digital Realty, Equinix, who have massive scale, deep pockets, and existing relationships.
Incumbents?
Right. There are also direct competitors like Core Scientific, which is another former crypto miner that, interestingly, also has large CoreWeave contracts. So direct competition for that key customer.
Interesting.
And of course, the hyperscalers themselves, Amazon, Google, Microsoft, often choose to build their own infrastructure in-house. You have the capital and expertise to do it.
What about regulatory challenges? Data centers are huge energy consumers. Are there any headwinds from that angle?
Absolutely. That's a growing concern. The enormous energy and water consumption of data centers is drawing increasing scrutiny globally. This leads to stricter zoning, permitting challenges, even moratoriums on new construction in some areas.
Like not in my backyard, but for power grids?
Kind of, yeah. There are also data sovereignty laws, like GDPR in Europe, requiring data to be stored within specific geographic borders, which creates demand for regional facilities. And grid interconnection hurdles are a major bottleneck. Securing permits and actually connecting these massive facilities to the grid can take 4 to 8 years sometimes.
4 to 8 years. Wow.
It's a huge lead time. Applied Digital's whole efficiency strategy, focusing on power and water, is a direct attempt to mitigate these growing regulatory risks.
That makes a lot of sense. What barriers exist that prevent new companies from just jumping into this space and doing what Applied Digital does? It sounds lucrative.
The barriers to entry in this specialized AI data center market are exceptionally high. It creates a protective moat, if you can get in.
Like what? What are the big ones?
First, massive capital investment. We're talking billions of dollars up front for these large-scale projects. But arguably the most significant barrier is access to power.
That grid connection problem again.
Exactly. Securing hundreds of megawatts is incredibly difficult, and those grid upgrades can take, like we said, 8 years or more. Then there's the specialized expertise needed for high-density, liquid-cooled facilities. It's not your standard data center build.
You need engineers who really know this stuff.
You do. And critically, there are high customer switching costs. Once a client like CoreWeave deploys billions of dollars worth of sensitive server equipment, relocating it is logistically complex, risky, and financially prohibitive.
So they're kind of locked in once they move in.
Pretty much.
Hmm.
It effectively locks in customers for the duration of long leases, like CoreWeave's 15 years, providing highly predictable long-term revenue for the operator. It's essentially building golden handcuffs.
So their unique assets and cost advantages sound like their core strengths. What about their brand strength? Are they well known?
Their brand is still pretty new, definitely nascent. Not in the same league as a giant like Equinix. However, that landmark $7 billion deal with CoreWeave, which itself is backed by NVIDIA, significantly enhances their credibility.
It's like a massive stamp of approval.
It really is. A powerful third-party endorsement that would have otherwise taken years to build organically. Their most unique assets, then, are their portfolio of development sites with secured large-scale power access and their proprietary AI factory designs. Finding suitable land with power is a huge challenge for competitors, making APLD sites incredibly valuable.
That's a strong position, but for a company making such an aggressive pivot and taking on immense debt, the team steering the ship is absolutely crucial. Let's shift gears and assess the leadership at Applied Digital.
Management evaluation.
Okay, leadership. The company is led by co-founder, chairman, and CEO Wes Cummins. He brings over 2 decades of experience as a technology investor with a background in capital markets.
So finance and tech background.
Right. And co-founder and CSO Jason Zhang also has an impressive pedigree, having worked at Sequoia Capital and Michael Dell's family office. They've clearly demonstrated strategic foresight by successfully executing that pivot from crypto to the AI/HPC market.
The pivot wasn't guaranteed to work.
Not at all. They also recently made a key hire with Laura Laltrello as COO. She has 20 years of executive experience in data center operations from Honeywell and Lenovo, so she brings serious operational chops.
That operational experience seems vital for actually building these things. Has they demonstrated an ability to handle crises when things inevitably go wrong?
Yes, they did face a significant operational challenge. There was a multi-month power outage at their Ellendale data center due to a transformer failure, which definitely impacted their financials.
Ouch. How'd they handle it?
Management successfully navigated it by procuring new transformers and restoring full capacity. It showed they have crisis response capability under pressure, which is important when you're dealing with critical infrastructure.
How transparent is management with investors and the public about these challenges and their strategy? Are they open?
Generally, yes. They maintain a consistent and transparent communication cadence. They host regular quarterly earnings calls, investor days. And they've been quite forthcoming about challenges like the issues during their cloud services transition and the strategic shifts, like the rationale for potentially selling that business.
Any red flags? Scandals?
Based on the available research, there are no indications of major ethical scandals. They seem pretty straightforward in their communications.
That's reassuring. Let's shift to capital allocation. Where are they putting their money right now, given the big plans?
Their capital allocation strategy is single-mindedly focused on aggressive reinvestment into HPC data center construction. It's all about building out capacity.
How much are they spending?
They plan to spend between $30 million and $50 million per month on expansion, primarily at their Ellendale campus to fulfill that CoreWeave contract.
Whoa, $30 to $50 million a month. That's serious cash burn.
It is. And their M&A strategy is actually that potential divestiture of their cloud services business we talked about. It's viewed as capital allocation discipline, sell the smaller unit to fund the bigger HPC opportunities, and simplify the business for that potential future REIT conversion.
Okay, so all focus on HPC build-out. What about shareholders? Are they buying back shares or paying dividends with any of this?
No, absolutely not right now. They do not pay a dividend, nor do they have a share buyback program. As a capital-intensive, hyper-growth company with negative cash flow, they are a net consumer of capital.
They need every penny for construction.
Exactly. They're plowing all available funds back into the business. However, a key part of the long-term bull thesis is the potential for a REIT conversion down the road. If that happens, REITs legally have to distribute at least 90% of their taxable income as dividends.
So dividends are a maybe way down the line if everything goes right.
Precisely. It's entirely contingent on successful execution of their current, very ambitious plans.
You mentioned capital being poured back into the business. How efficiently are they using their invested capital right now? What's the return?
Well, this is where it gets stark. Their return on invested capital, or ROIC, as of February 2025 was a deeply negative, a negative 8.17%.
Minus 8%. So they're losing money on the capital they've invested so far.
That's right. It's not just losing money overall. It's a direct measure showing that on an operational basis, for every dollar they've invested, they're currently destroying value.
Is that typical for this stage?
It's not entirely unexpected for a company undertaking massive long-term construction projects that aren't generating full revenue yet, but it absolutely underscores the immense risk involved. If these projects fail or face significant delays, that invested capital could be permanently impaired. There's no guarantee of success.
That makes the financial health of the company even more critical. Let's dive into the hard numbers.
Financial analysis.
All right, the financials. As of June 24, 2025, their market capitalization stands at approximately $2.32 billion. This places them firmly in the mid-cap category.
So, potential for growth, but also higher volatility and risk than large caps?
Generally, yes.
What about their revenue growth trends over the past 5 years? How has that big pivot impacted the top line?
The revenue growth has been explosive, reflecting that rapid transition and aggressive scaling. They went from virtually no revenue in fiscal year 2021.
Really? Near zero.
Practically nothing significant.
Yeah.
To over $165.58 million in fiscal year 2024, and as of February 2025, their trailing 12-month revenue reached $221.2 million.
Okay, that is hypergrowth. That's a core bullish point, I imagine.
Absolutely. It showcases their ability to capture market share quickly in this booming sector.
But does that impressive growth translate to profits, or is it growth at any cost?
Yeah, that's the catch. Unfortunately, no, it doesn't translate to profits currently. Their profit margins are extremely weak due to the high costs of scaling and servicing their debt.
How weak are we talking?
Their gross profit margin was razor thin, just 7.14% in Q3 2025. Their operating profit margin was a negative 39.11% on a trailing 12-month basis, showing deep unprofitability from core operations.
Minus 39% operating margin.
And their GAAP net profit margin for Q3 2025 was even worse, a substantial negative 68.21%. That's driven by significant losses and, crucially, those high interest expenses from their debt.
Right. Now, I often hear companies like APLD talk about adjusted EBITDA being positive, even when their net loss is still huge. Can you clarify the difference between those two figures and why it's such a debate for investors?
This is a central debate for investors with companies like this, and it's vital to understand. In Q3 FY25, their adjusted EBITDA was positive $10.0 million.
Okay, positive $10 million sounds better than a loss.
It does sound better, but EBITDA ignores interest, taxes, depreciation, and amortization, and the adjusted version often removes even more non-cash or supposedly one-time items. However, for that same quarter, their GAAP net loss was $36.1 million.
So a $46 million difference between adjusted EBITDA and the actual bottom line. Where did that gap come from?
It's because adjusted EBITDA ignores significant, very real cash expenses like $8.9 million in interest payments on their debt, and also large non-cash charges like $18.8 million in depreciation on their assets.
So for investors, the question is adjusted EBITDA a true signal of improving operational health, or is it kind of a misleading metric that papers over the cracks of financial strain and the true cost of their debt-fueled growth?
That's precisely the debate. You have to look beyond the adjusted number to see the full picture.
And speaking of cash, are they generating any free cash flow, or are they burning through it to achieve that revenue growth?
They are deeply and increasingly negative on free cash flow. The cash burn is immense.
How bad is it?
They burned $251.6 million in free cash flow in Q3 2025 alone.
$250 million in 3 months.
Yes, and their trailing 12-month levered free cash flow was a staggering negative $438.27 million as of February 2025. This just highlights their absolute dependency on external financing, debt, and equity to survive while they build. This cash burn is one of the most critical aspects for investors to monitor closely.
So no consistent earnings then, just consistent losses widening as they invest. How much debt are they carrying to fund all this growth? This is a huge concern for a company burning cash like that.
You're right to be concerned. They are carrying significant leverage. Their debt-to-equity ratio was reported as 1.56 using long-term debt, or potentially as high as 2.76 if you include all debt liabilities.
I mean, in dollar terms.
As of February 28, 2025, they held $689.1 million in total debt versus only about $261.2 million in cash on hand.
So way more debt than cash.
Considerably more. This heavy reliance on debt makes them highly sensitive to interest rate changes and really dependent on lenders for their very survival and continued expansion.
And what about their short-term liquidity? Can they even meet their immediate obligations like payroll and suppliers without, say, raising more capital constantly?
That's another area of concern. The current ratio was 0.70 as of February 28, 2025.
Below 1.0? That's usually a red flag, right?
It's a textbook red flag, yes. It indicates negative working capital. This suggests they could face challenges meeting short-term obligations without raising more capital or restructuring existing debt. Given their massive cash burn, this isn't just theoretical. It's a very real operational challenge they have to manage constantly.
Okay, this financial picture is precarious. Moving to valuation. How do we even value a company like this that isn't profitable yet and is burning so much cash? Traditional price-to-earnings ratios are useless here.
That's correct. When earnings are negative, PE isn't meaningful. So analysts often turn to the price-to-sales PS ratio. APLD trades at a forward PS of about 8.97x.
Is that high or low?
It's substantially higher than its own 5-year median PS, which was around 1.44x, and it's generally above the industry average for data center providers, though comparisons are tricky.
So the market is pricing in extremely high expectations for future revenue growth, mostly from CoreWeave.
Exactly. That high PS multiple is largely predicated on the successful execution and ramp-up of that massive CoreWeave contract. For an intrinsic valuation, trying to figure out what it's really worth based on fundamentals, we look at a discounted cash flow, or DCF model.
Explain that briefly.
Sure. A DCF forecasts the company's future free cash flows, assuming they eventually become positive, and then discounts those future flows back to their present value, adjusting for the time value of money, and crucially, the risk involved. It's a powerful tool, but its output is highly sensitive to the assumptions you plug in.
So what does your educational DCF model suggest for APLD?
Our model yields a very wide estimated intrinsic value range, $8 and $15.50 per share.
$8.50 to $15.50, that's a huge spread. Why so wide?
The wide range directly reflects the binary nature of this investment we keep talking about. There's substantial potential upside if they execute successfully, pulling the value towards the higher end. But there's also significant risk of setbacks, delays, or failure, which would push the value towards the lower end, or perhaps even below it.
What are the key assumptions driving that massive spread in the DCF?
Primarily the revenue growth rate. It's directly tied to the phased ramp-up of that $7 billion CoreWeave contract. We assume the first 100 mil W comes online in Q4 2025, the next 150 mil W in mid-2026, and then steady revenue after that with a terminal growth rate of 3%. Any deviation there dramatically changes the outcome.
And the risk factor, the discount rate.
Exactly. We used a high discount rate, weighted average cost of capital, or WACC, of 12% to 14%. This elevated rate quantifies APLD's substantial risk profile. Their high financial leverage, the significant execution risk on construction, their negative cash flow requiring continuous capital raises, and that extreme customer concentration on CoreWeave. A lower risk company might have a WACC closer to 8–10%.
That certainly highlights the high-stakes nature of this bet. Let's move into how the market in general perceives Applied Digital beyond just the valuation metrics.
Market sentiment.
Okay, market sentiment. Looking at Wall Street analysts, the sentiment is actually quite bullish overall. There's a strong buy consensus rating.
Really?
Right.
Despite the risks?
Yes. Out of 10 analysts covering the stock, 8 rated a strong buy, 1 rates it a buy, and only 1 has a hold. No sells. The average price target is $13.55, with a high estimate of $18 and a low of $7.
So analysts are betting on the upside potential, outweighing the risks, it seems.
Right.
What's been driving the news and general media tone around the company lately?
The news has been overwhelmingly dominated by that $7 billion CoreWeave lease agreement. That was the primary catalyst for a significant stock surge earlier, and it really validated their whole HPC strategy pivot in the eyes of many.
And how does the media frame them?
Generally, as a high-risk, high-reward pick-and-shovel play on the AI revolution, the narrative emphasizes the transformative potential if they can deliver on these massive projects.
What about market indicators like short interest? That can tell us a lot about skepticism in the market tree.
Absolutely, and this is where it gets really interesting. Short interest in APLD is extremely high. Depending on the source, it's sitting between 27.92% and 36.13% of the float.
Wow, over a quarter, maybe over a third of the available shares are being shorted.
Yes, that's significantly above the peer average, which is typically around 6% or lower for data center companies. This indicates APLD is a true battleground stock. A very significant portion of the market is actively betting against it.
What does that mean for the stock price?
It creates extreme volatility. High short interest means potential for sharp downward moves if negative news hits, but also potential for dramatic short squeezes upwards if there's positive news that forces shorts to cover their positions. It's a clear signal that there's deep division and uncertainty about its future prospects.
Despite that high short interest, how does the price look relative to its moving averages? Is the recent trend up or down?
As of that June 24th, 2025 date, the share price of $10.36 was actually comfortably above its 50-day simple moving average of $7.26. That's generally seen as a bullish short-term momentum signal.
And the longer term?
It was also well above its 200-day simple moving average of $7.61, indicating a bullish long-term trend as well. So, despite the high short interest, recent price action leading up to that date had been positive, suggesting bullish sentiment was winning out in the short term, perhaps driven by anticipation of the CoreWeave project progress.
That's a fascinating tug-of-war between the bulls and the bears.
Yeah.
Let's look at who actually owns Applied Digital. Who are the major players here?
Ownership structure.
Okay, ownership. Institutional ownership is substantial at 62.101% of outstanding shares, which definitely lends credibility. Having big funds involved is usually seen as a positive.
Who are some of the key holders? Any big names?
Yes, familiar names like BlackRock, Vanguard, D.E. Shaw are holders. The largest single institutional holder is Hood River Capital Management, with about a 9.45% stake. Interestingly, there was a net inflow of institutional capital in Q1 2025, suggesting that, on balance, big money was getting more interested or adding to positions earlier this year.
What about insiders, the management team and directors? Are they buying or selling their own company's stock? That's often a key signal.
Insider ownership is significant, estimated between 10–20%, with CEO Wes Cummins being a major shareholder himself. However, looking at recent transactions, there's a clear pattern of selling.
Selling. Tell me more.
Over the past 12 months leading up to our analysis date, there were 27 sell transactions by insiders versus only 8 buy transactions. More recently, in the most recent 3 months, there were 5 insider sells and 0 buys.
0 buys in the last 3 months, only sells. How should we interpret that?
Well, insiders might sell for various personal reasons, diversification, taxes, etc. However, a consistent pattern of selling, especially with no corresponding buying activity, can be interpreted by the market as a bearish signal. It suggests insiders might not see the current price as a compelling buying opportunity, or perhaps they're locking in gains given the risks.
That's definitely something potential investors would want to note. Is their ownership concentrated among just a few large holders? Could that impact volatility?
Yes, ownership is quite concentrated. The top 11 shareholders control approximately 52% of the company.
So more than half the company is owned by just 11 entities.
Right. This means decisions by just a few large funds, if they decide to sell or buy large blocks, can have an outsized impact on the stock price, potentially increasing volatility.
Now, what about that peculiar situation with CoreWeave, their cornerstone customer? Didn't they sell their stake in Applied Digital?
Yes, that was a particularly noteworthy event. CoreWeave, APLD's absolutely critical customer, sold its entire equity stake in the company.
That sounds like a huge red flag. Your biggest customer dumping your stock.
It certainly raised eyebrows. However, the market largely looked past this because, simultaneously, CoreWeave explicitly reaffirmed its commitment to that massive $7 billion 15-year leasing agreement.
Okay, so they said, we're selling the stock, but we're still 100% committed to the massive contract.
Exactly. The interpretation was that it was likely a financial decision by CoreWeave, perhaps related to their own massive capital needs for buying GPUs, rather than a reflection of any doubt in APLD's ability to deliver the data centers. But it definitely added another layer of complexity to the story.
So it sounds like a complex mix of powerful strengths and significant vulnerabilities. Let's use a SWOT analysis: strengths, weaknesses, opportunities, threats, to frame their overall risk profile.
Risk assessment.
Okay, SWOT analysis. Let's start with internal strengths. First, their strategic focus on AI/HPC. That was an astute and timely pivot to capture a high-growth market.
Good timing, definitely.
Second, their potentially cost-advantage model. Using that low-cost, stranded power and favorable cooling climates in places like North Dakota, that could be a durable edge.
If they can execute it consistently.
Right. Third, their validated execution capability, primarily demonstrated by landing that landmark $7 billion CoreWeave deal. It proves they can win big contracts. And fourth, their experienced leadership team, which combines investing acumen with growing operational expertise, especially with the new COO.
Okay, those are solid strengths. What about their internal limitations, their weaknesses? These seem significant from our earlier discussion.
They are very significant. First and foremost is their precarious financial health. We're talking deep gap losses, significant ongoing negative free cash flow, high debt levels, and that worrying current ratio below 1.0.
The financial foundation looks shaky.
It does. Second, there's monumental execution risk. Their entire future hinges on completing a massive, complex construction project on time and, crucially, on budget. Any major slip-ups could be disastrous.
It's a huge construction project, basically.
Exactly. Third is the extreme customer concentration. Relying so heavily on CoreWeave is both their biggest strength right now and a critical weakness. If anything disrupts that relationship or CoreWeave's own business, APLD is incredibly exposed.
All their eggs in one very large basket.
Pretty much. And finally, there's subscale operations. They're still much smaller than the established REITs, which could mean less access to capital markets on favorable terms and less bargaining power with suppliers or future customers.
Okay, now let's look outside the company. What external opportunities exist for them in the market that could accelerate their growth or improve their position?
The biggest opportunity is simply the explosive AI market growth. They're riding a massive wave, a powerful tailwind. There's also future expansion potential. They have a pipeline of additional sites where they could potentially replicate their AI factory model if the first one succeeds.
Build more factories for other customers.
That's the hope. Another long-term opportunity is that potential REIT conversion. If they can stabilize the business and generate consistent cash flow, converting to a REIT could lower their cost of capital and attract a whole new class of income-focused investors.
That's the potential endgame.
It's a key part of the long-term bull case. And finally, the CoreWeave validation could open doors for new strategic partnerships, landing similar large-scale leases with other hyperscalers or major AI players.
Makes sense. And what about the external threats? What could derail them from the outside?
There are plenty of threats. Intense competition is a big one, from those larger REITs, other AI-focused players like Core Scientific, and the hyperscalers building in-house.
They're not alone in chasing this market.
Far from it. There are also growing regulatory and environmental headwinds regarding energy and water consumption, which could lead to stricter regulations, permitting delays, or even moratoriums that could halt expansion plans.
The regulatory landscape could get tougher.
Definitely. Technological obsolescence is another risk. AI technology is evolving incredibly rapidly. What if future AI chips require fundamentally different data center designs or cooling methods? That could make their current factories less optimal. And while it's less central now, crypto market volatility still poses some risk to their legacy hosting business segment.
How do broader macroeconomic factors like inflation or interest rates impact a capital-intensive company like Applied Digital? They seem particularly exposed.
Highly exposed. Inflation is a major threat. Rising costs for essential materials like steel and concrete, key equipment like transformers, and skilled construction labor can lead to significant budget overruns on their projects, crushing profitability.
Makes building those factories much more expensive.
Exactly. And interest rates are critical. Their growth is heavily fueled by debt. Higher interest rates directly increase their cost of capital, making it more expensive to service their existing $689 million in debt, and crucially, making it harder and more expensive to secure the future financing they absolutely need to complete construction and survive until cash flow turns positive.
So rising rates are a double whammy for them.
A very significant one.
Are there any specific geopolitical threats that could impact their operations or costs, perhaps relating to their supply chain?
Yes, supply chain and tariffs represent a material geopolitical risk. They rely heavily on a global supply chain for critical hardware components, particularly servers and GPUs, many of which are manufactured in or sourced through China.
Like NVIDIA GPUs.
Right. The potential imposition of steep U.S. tariffs on goods from China, some proposals have been as high as 145%, would dramatically inflate their capital expenditures.
145%, that would be crippling.
It could be. Imagine a $500 graphics card suddenly costing over $1,200. For a company buying thousands of these, it could crush project profitability or force them to raise significantly more capital, likely through dilutive stock offerings. It's a serious threat to watch.
We've covered a lot of ground today, unpacking the business, the management, the financials, market view, and risks. Let's try to synthesize everything we've learned and build both the bull and bear cases clearly.
Conclusion.
Okay, let's summarize. The key bullish points are compelling. APLD offers investors a compelling pure-play exposure to the AI infrastructure supercycle, having made a successful and decisive pivot to building these specialized AI factories.
They bet on the right trend.
They certainly seem to have. The transformative $7 billion 15-year CoreWeave contract is the centerpiece, providing immense long-term revenue visibility and powerful validation from a major AI player. And their potentially cost-advantaged model, leveraging low-cost power and natural cooling, could represent a durable competitive moat if executed properly.
So the bull case is great market, key customer locked in, cost advantages.
And critically, if management executes on their ambitious construction plans, there's a clear path to significant revenue growth and potentially that evolution into a stable, dividend-paying data center REIT down the line.
Okay, that's the optimistic view. Now, what's the summarized bear case? What are the biggest hurdles and reasons for caution?
The key bearish points are equally stark. First and foremost is the monumental execution risk. Their entire future depends on completing a massive, complex, capital-intensive construction project on a very tight schedule. There's little room for error.
The build it and they will come risk, but on a massive scale.
Exactly, but the coming part is secured. It's the build it part that's the challenge. Second is their precarious financial position. Deep gap losses, significant ongoing cash burn, and a heavy debt load make them highly vulnerable to any operational hiccups or changes in the capital markets, particularly rising interest rates.
The financial tightrope they're walking.
Precisely. Third is the dangerous concentration on a single customer, CoreWeave. Well, the contract is great. This reliance is a double-edged sword. Any disruption to CoreWeave's business or the relationship could be catastrophic for APLD. And finally, you can't ignore the extremely high short interest as a form of market validation of these significant risks. A lot of smart money is betting against them.
So execution risk, financial fragility, customer concentration, and market skepticism. Let's revisit the valuation from our DCF model one last time. What did that wide range tell us?
Right. Our educational DCF model yielded that wide estimated intrinsic value range of $8.50 to $15.50 per share. The breadth of this range directly reflects the high degree of uncertainty and the binary nature inherent in this investment. It really captures the bull versus bear tension.
So what does this all mean for you, the listener, today? Where does Applied Digital stand relative to that value range as of our analysis date?
As of June 24, 2025, APLD's share price of $10.36 falls squarely within that estimated intrinsic value range.
Right in the middle, basically.
Pretty much. This suggests the market is, on aggregate, attempting to price in both the enormous potential upside from the secured contracts and the very real and significant risks we've discussed. Based on this DCF, it doesn't appear to be a deep bargain, nor does it seem excessively overvalued at that specific point in time.
So what determines where it goes from here?
The ultimate share price trajectory will likely be determined by the company's tangible progress or lack thereof over the next 18-24 months. Can they meet construction deadlines for the Ellendale campus? Can they manage that intense capital burn effectively? Can they successfully bring the CoreWeave capacity online and start generating substantial revenue and, eventually, positive cash flow? Execution is everything.
Okay, a final provocative thought for our listeners then. As you reflect on APLD, consider this. In an AI gold rush, everyone needs picks and shovels. Applied Digital is aiming to be the primary supplier of those tools, these AI factories. But what happens if the nature of AI workloads changes composition, or if too many prospectors like the hyperscalers decide to bring their own shovels?
That's a great question to ponder. And please remember, this deep dive analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice.
Definitely. We strongly urge you to conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions based on this or any other information.
Your own due diligence is crucial.
And if you found this deep dive valuable, please like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority deep dives on tickers just like APLD. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access.
And if you just want a one-off deep dive on a specific stock you're interested in, you can always drop us a super thanks on the video.
Thanks for tuning in to the deep dive.